Hey traders, Steven here with thetradersplan.com. It's Wednesday, February the 6th, about midday, a couple hours into the market open. We're going to take a look at some things. We're going to look at the overall market, gold, bonds, and yields, and then we're going to look, we're going to go over my watch list. I got about 25 stocks. We're just going to go through some charts, kind of look at some setups, some things to think about, maybe add some of these stocks to your watch list. But you know, there's a lot of things going right now. You know, we're in a really strong rally. So we have a lot to cover. So I'm going to get right into it. You know, we got the Nasdaq right here. Okay. And you can see that obviously, the 50 is still way under the 200-day, but it's curling up. Now you have this down trend line on the Nasdaq, and the Nasdaq broke, that down trend line right there, right on that big volume day right here on January 31st, and has been headed higher ever since. So, you know, I'm going to make some cases for the bulls and bears today, but at the end of the day, just kind of follow the price action. So today, you know, the market is approaching the 200-day moving average, and this is an obvious place for resistance. But, you know, there's a couple things I want to talk about, and I want to talk about, you know, the fear of missing out, right, on some rallies. It's very important when you get some signals down here to put some money to work, because, you know, you never know how long the rally is going to last. And, you know, when you put some money to work, you don't want to take profits too quick. You can always just say, hey, you know, if the market moves above the 20-day moving average, I'll just use that as my stop, okay? So you have a big rally coming off the bottom, a bear market rally, and I'm going to call this a bear market rally really until, you know, we break and hold the neckline right here, until the 50 comes back above the 200-day, and you can still, it's way down here. But there's a couple things to think about on this rally. Could be getting long in the tooth. Now rallies can always, you know, continue to go, or they can be really short. But here's kind of the bearish case. Typically, when you're in a rally, you know, you can get a couple tests of that 20-day moving average. And then typically the third test is sometimes when the rally gets tired, right? It's just like any stock. The stock can base twice, and on that third base, sometimes the breakout fails because just the stock is tired. It needs longer to consolidate. So right here, you know, we had a surge above the 20-day moving average, this green line, and you had test one. Let's just call this 2 test, even though it did touch it right here. Or you could call this test 1 and this test 2, right? So the market, the Nasdaq has tested the 20-day moving average twice already as a successful test of support. History shows, at least when I have studied these rallies, that sometimes the third time is not always the charm. Sometimes the third time is when you need to be cautious. So that's something to consider, and we haven't tested the third time. So that you can see right here, this downtrend line, this 7,200 level would probably be where this 20-day moving average would catch up, and that could be, and also could be right at, you know, this breakout level. So, you know, I see 7,200 level as a potential short-term support zone. So if that breaks, you know, I think you need to be a little cautious. But right now we're above it. Another thing to consider, and maybe just a case for, you know, don't try to chase this, at least right now, is because the Nasdaq right now is about 4% above the 20-day moving average. And if you compare, and that's pretty stretched, okay? Not always the best place to get on board. And just to compare that, you can see over here, and this is the beginning of, you know, the waterfall at the beginning of 2018. Right here at the very peak of this, the Nasdaq was above, and this is a pretty straight up shot. The Nasdaq was 3.5% above the 20-day moving average before it broke. And on this reversal day, it was 4% above the 20-day moving average, and then it broke. And now, right now that it's you know, 4%, it was 4.2 pre-market, so it's probably, you know, 4% right now. So that's just pretty extended. So again, you know, you have to be patient and let the market come to you. You have to be, in my opinion, willing to let some of your stocks ride, but also, not continue to chase what I think is an extended rally. Now, this rally could continue, but I think you need to let the market come into you a little bit. See if it can successfully test this 7,200 level, maybe create a little right shoulder. Maybe it even comes down a little bit further and then gets out of this. I don't know if it's going to do this. I don't know if it's, which way it's going to go. I always, say, okay, where can the market, shake me out, right? So right here, I'm never surprised when, the market continues to overshoot potential resistance. And it can even, I wouldn't be surprised if it just kind of gaps up above this, like these two gap ups right here, like it just gapped up and then rolled over, gapped up right here, then rolled over. It did gap up right here, broke out of the downtrend line and continued, but I just think we're at an interesting place, and I don't know if we're going to head out of here or not. I'd be incredibly surprised if this bear market was complete V-shaped, because most of them are double bottom at the very least. But all I'm saying is, I would be cautious on taking too many new positions based on where the market is at. It's okay to let it go for a little bit, because we're trying to invest over time where the odds are in our favor. And if you're consistently putting money to work when the Nasdaq or the S&P 500 is 4% above the 20-day moving average, I think most of the time it's probably not going to work unless you're just looking for a really, really quick profit target. Then it could. But just look at this. You let history be your guide and you make the judgment call. But I think the market is extended, looking to pull back to the 7,200 area, but it could just give it one last hoorah, just like here and just like here. So, and then we got this big 800-pound gorilla, the 200-day moving average, which could be resistance. So we'll just really have to wait and see. Now the S&P 500, looks very similar. It is, successfully tested the 20-day moving average a couple times and is now right at this 200-day moving average. So right now the market, it really depends on where it finishes, right? And sometimes it doesn't have to just bump up against the 200-day moving average and then slam back down. It could climb through it a little bit. So it's not the end-all be-all, but it's kind of an area just to keep in mind. And again, I do think that the rally is a little extended, and I think you want to wait for a pullback and be patient. Don't have that fear of missing out, because every time I just get this euphoric feeling where, man, the market just keeps going up. I got to own more stock. I got to feel invested. Just throughout history and experience of my trading career, that's typically been pretty close to the top. And even though you can put money to work, doesn't mean it's going to just roll over immediately. But I think you're going to struggle to get too far up. You want to think of turns and risk reward 3-to-1, at the very least 2-to-1. And if you don't see, your stock, if you getting 2-to-1 at the minimum, that's probably a setup that you can just pass on. I think a good idea right now is a lot of the stocks that are way extended, let's see if they can pull back, because they are the leaders. Let's look at breadth real quick, because you can see that 93% of stocks are above their 20-day moving average. That's very bullish. 98%, and we just kind of just go down the line: technology, financials, discretionary, industrial, very strong, healthcare, 88, staples, energy, materials, and then you have utilities. So it looks like industrials are the winners, and then utilities. So still got a lot of strength and a little bit of defense. Something to keep in mind, but they're all strong right now. So I would just, again, I'm kind of waiting to see if this starts to kind of curl a little bit, then I would be cautious. But if we go to kind of the longer term breadth chart, which is really what I prefer to look at, so you don't get too many signals, this is shot right up out of here. That 60% of S&P 500 stocks above the 200-day moving average, that is back in the area that you want to be in. Doesn't mean this isn't, just mean go out and buy with abandonment, but, breadth is strengthening. you can see right here, if you compare it to 2015, so I would just be cautious, is it went straight up, you know, made everybody feel warm and fuzzy, and then it struggled, second leg down. So a lot of times these moves, these legs, they don't necessarily go straight up, straight down, straight up, straight down. Sometimes they can go sideways for a while and just stall, and if they can't, you know, get moving in a while, consolidations are healthy, but, you know, a lot of people get chewed up and spit out in consolidation, so I would just kind of keep this in mind. The last time we had a major dip below 40% and back above 60, it didn't stay there very long, and this is shot just straight up. So just be cautious, let the market come to you. Emerging markets is definitely very interesting. It's definitely something worth looking at. I always look at, okay, when you're coming out of a weak market, what's leading out, right? What is the strength coming out? So I'm looking at EEM, the emerging markets ETF, and you know, this is way above its long-term moving average, the 200-day. You can see right here, the red line is the 200-day, so it's shot way above here. It never made a lower low when the market made a lower low back in December. And the 50-day moving average is getting closer to crossing back above it. Now, again, I think this is shot straight up. You want to let the market come to you a little bit, but this is a chart I would seriously consider, because, you know, you had, when that 50-day crossed above the 200-day right here, you had a really, really good run, and then it crossed below. Nice correction, and when it crosses back above, it could be back above it for a couple years. Could go on a nice run. So the best markets, strongest markets, are coming out of bear markets. So you don't want to be too chicken. You want to be willing to put some money to work and just use your stops. Now, this is a relative ratio chart, emerging markets to the S&P 500. So you can see right here, going all the way back to 2014, emerging markets, the long-term chart, has really underperformed the S&P 500 since 2014. And now it's getting close to a short-term relative ratio breakout. This is kind of a 12-month downtrend line. You can see right here, it's just bumping up against it. And then you have this long-term downtrend line. So if it breaks above here, I would already seriously start considering, you know, some emerging markets. But it's significant. It's definitely significant if it breaks through this downtrend line. That is a significant trend line, and if it breaks through that, I would look for a potential, you know, multi-year outperformance of emerging markets versus the S&P 500. And this is really looking interesting because you have gold that, you know, also is correlated with emerging markets and inversely correlated with the dollar. Gold is looking strong too. So we could go look at that. And you know, I kind of keep coming back to this gold miners chart, but again, you have GLD up here. You know, a nice correction, broke out of that neckline, you know, steady rising GLD. You have the GDX, which has gone nowhere for years, and, you know, broke all these support levels in GDX, and then really created a cup with handle. And notice how the handle is on top of this pivot right here, and came back and found support at the pivot, at the 50-day moving average, and just surged out of here. I think this surge is significant, and I think it could potentially, you know, change direction of, you know, gold miners to be an outperformer. It's clearly outperformed the S&P 500 since September, but I'm talking potential much longer. This is extended right here. It could pull back to this pivot, but I think this is a trend change, and we're getting very close. And you can see down here, miners, the miners to GLD chart, the relative ratio, miners are outperforming the metal, bullish. Dollar is consolidating. It broke this trend line, but it hasn't broken down significantly. You can see it could be coming out of here. So I think that is something to watch to see what gold does. If the dollar kind of breaks out of this, you know, the uptrend continues for the dollar, which would negatively impact the gold. So I think right now, just because gold is clearly the more bullish one, you want to be on the bullish side of gold and gold miners, but this is not something to ignore down here, the US dollar. So just really keep that in mind. If we look at bonds, let's look at the TLT. This breakout is still holding that breakout of a 2-year down trend line, and bonds are going to break out before stocks. They typically come out of bear markets before stocks, and they typically start a bear market before stocks. And I mean, that intermarket relationship is holding true, but you can see the breakout, the test of the breakout. Bonds are holding, yields are struggling. So they have an inverse relationship, and you can see right here that utilities are highly correlated to TLT, right? So if bonds are showing strength, a lot of times utilities are going to show some strength, even though there are going to be some pockets of inverse relationship. But you can see for the most part, the lines are up here. And they're mostly correlated to REITs as well. So if bonds are headed up and yields are headed down, typically that's good for REITs and utilities. And I would say they're moderately correlated with telecom. You know, I don't think they're nearly as correlated, but telecom is a dividend type paying stock. So if we look at bonds are strong, then that should mean that yields are weak due to the inverse relationship. So you can see right here, this chart goes all the way back to 1975, the peak in yields in late 81. So you have really a 30 to 40 year bear market in yields, and then I would say this breakout was definitive. All of a sudden starting a new secular bear market in yields, which would be a secular bull market in bonds, but it's kind of got shoved back down. Yields are getting weaker, so I don't know if this is a false breakout or not. It could kind of find its place, settle down, but this could be a false breakout. And I mean, right now it's just doing the opposite of what bonds are doing, so it's just kind of something to keep in mind. But yields are also positively correlated with financials. So, if this breaks down completely, and this is a very, very long-term chart, so I wouldn't, this is a weekly chart, but this is a long-term chart, as you can see on the years. It would be negative for financials, and then positive for yields because they're negatively correlated with utilities. So, something to keep in mind. And I do want to show the chart that I continue to show on the gold side, because I was talking about emerging markets breaking out or close to breaking out relative to the S&P 500 going all the way back to 2014. Well, this is a relative ratio chart of gold versus the S&P 500. And you can see right here that gold broke out relative to the S&P 500 of a 7-year downtrend line. So I think that's significant. Let's just keep an eye on it, but gold is surging. It's breaking out versus the S&P. Emerging markets are leading. So if you look at the big picture of things, you could have new leadership coming out of the market. And, I think the dollar matters right now, but, the S&P could take a back seat for a while. See the Nasdaq's kind of breaking a little bit. We'll just kind of keep an eye on this. So, I do want to do something different today. I want to go through my watch list, and I'm just, I don't want you to go out, full disclosure, don't go out and buy these stocks blindly just because you see them on the screen. Don't do that. Make your own decisions. But, we just want to look at some setups, that look interesting. But one quick thing I continue to want to show you is I have an ETF list, relative strength, 3-month relative strength. Of 250 ETFs. Look at what's on top, solar. Solar is just surging out of here, and the last time you can see solar really got beat up from 2015 to 2017, and then had a really nice rally, and now it just got beat up again. So got some accumulation stepping in. So solar stocks are looking a little bit interesting right now. They're leading the pack, but look at what is all on top. Brazil, Egypt, Turkey, Brazil, gold. You do have some technology up there, Argentina, gold miners. So just a lot of gold, a lot of emerging markets. They could be leaders for a while. So just really keep that in mind. So let's look at some stocks. Let's just kind of look at some individual stocks, some charts that I think look really interesting. And I'm not going to go through all of these, but I think one stock that looks interesting. Now, this is a volatile Chinese stock. This is a electric. They sell electric vehicles and parts. You know, I don't know if you want to call them the Tesla of China, but you know, this stock broke out, has found support just under $6, broke out clear as day. The volume stepping in. You know, that's what you want to see. And I did miss it. I did miss it, and the next thing I know, it was extended a little bit, and I do think it's extended now, but you know, this looks like the beginning of a right side climb, and this is what I look for. I look for, okay, you start to get a little volume pop, and then when the pullback happens, is it on low volume? And then when the volume steps, or when the stocks climb again, is it on above average volume? So this is really textbook price and volume action that you want to see. Now, on the fundamental side of things, the most recent quarter was 213 million. Not anticipated to earn a profit, but some mutual fund ownerships are increasing in this stock. So this is just, it's looking interesting in the fact that the market is looking vulnerable, and this is still up and above average volume. I always look at what is up when the market is down. I say, okay, these stocks clearly don't care that the market's pulling back. There's no sellers here. Lovesac, I made some money on this pop right here, bought the pullback, and now it's trying to take another stab at this breakout area. Did break out of here. There's no really volume on that versus the volume over here. So I think that if you want to look at an interesting company, they have interchangeable couch cushions. They are a furniture company. I would just go to lovesac.com. Look at the mutual fund ownership has tripled in just 3 quarters. Not anticipated to turn a profit in 2020, but look at the sales growth. It has increased every single quarter the last 7 quarters. So a very interesting company, a very interesting stock, very new, very thin, but you know, it's trying to find its way. And I think that if it kind of comes back here and does another one of this, assuming the market pulls back, I would pay attention to this rising 50-day moving average to see if it finds support. So First Solar, you know, I'm looking at some of the strongest solar stocks. Canadian Solar, we'll look at this one real quick, is the leader out of, let me just type this in, CSIQ, is the leader out of all these stocks. A very, very spotty earnings, but look, if you want to look at this on a weekly chart, I mean, I could draw so many trend lines, but let's just start from up here. I could draw one right here. I could draw one right here. I could draw them, you know, across. But either way, this thing has been basing for 3 years and is now getting out of it. And it's getting out of it in above average volume. And that's something worth paying attention to when all of a sudden a stock has gone nowhere for 3 years and then really, really starts to wake up. It's very rare. I wouldn't say it's very rare, but you know, when a stock goes nowhere for several years, this is a monthly chart, and all of a sudden wakes up, that's when you want to pay attention. You have a monthly chart right here. You know, I wouldn't necessarily call this a flag, but it's moving higher. It's climbing the right side of this 6-year downtrend. So, and other other solar stocks are paying attention too. So it's definitely something worth noticing. Roku, own this, sold it too early, but you know, it made a bullish surge off the bottom, bullish consolidation, and it just kind of really broke through huge on Monday on above average volume, and is just kind of riding that 5-day moving average. So I tend to think that it could pull back and catch this rising 20-day, but you know, I'm going to go back to Lovesac, and we're thinking of companies here. Let's look at companies, and you don't want to buy and hold. I'm not going to tell you to buy and hold anything, but, you know, we talk about some of these interesting game-changing products, you know, the Roku. I'm a young guy, but everybody I know, you know, all my friends, everything, they're all ditching cable to go to, you know, Netflix, you know, Hulu, Roku products, Amazon Prime, things like that. I think this is the future of entertainment. and Roku seems to be a leader in that future. Gold, this Yamana Gold, now this is a lower price stock, so that with that carries more risk. I'm not telling you go out and buy it, but look at the volume spike stepping in, and it's really just starting to, it broke out of this downtrend right here. A lot of accumulation is coming out of this. Now it's trying to, it broke through the 200-day moving average, and it's trying to consolidate above the 200-day moving average. So I think this is one worth putting on your watch list. Unless you don't buy, I don't normally buy low price stocks, but you know, gold and solar stocks, they all really have spotty earnings and sales, but earnings are revised up for 2018 and estimated 2019. So something is happening with gold, as you saw the ETFs a second ago. It's worth paying attention to some of these leading stocks. And I do want to go look at Kirkland Gold, because I think, you know, this is the leader clearly. But look at this. This thing went straight from 18 to 33. That's a big move. That's, you know, a 90-80% move. That's almost a double in just a few months. Now, most gold stocks have not done this, but look at how nice and neat this move is. This stock is extended, but you just have you know, straight up move. And with GDX, and you're looking at all the evidence, the leader is leading, GDX is moving right. So you just really have, you know, these gold stocks that I really think they're worth paying attention to. Deluxe, I sent this out, I think, a couple of weeks ago, but I like the nice and neat move. And again, I'm looking for volume. That's what I'm looking for right now. And it popped on earnings. Now, this is a check maker, so not necessarily sexy, but I'm sure they're trying to, I'm sure they have a diversified business model. But I mean, it popped, it went straight sideways, and it's trying to move higher. I personally think it's a little bit extended, but if this kind of pulls back with the market and consolidates, this could be one to look at. Celgene. I didn't read the news on why this popped so much, but it did, and now this is incredibly bullish, because look, it popped and it's not even filling the gap. It's going nowhere. Then it had an earnings report, didn't give that back. You know, if we look at some of these, I mean, look at how big that surge off the bottom was. You know, it really hasn't, it kind of peaked right here in late 2017, but now it's doing something different. Earnings are anticipated, or estimated at 20% in 2019. You know, PE low. I don't look at PEs, but I mean, that's pretty undervalued, and just consistent sales growth. So this could be just one of those large cap biotech stocks that is looking like a potential turnaround. Now, I talked about leaders, and this is the one I missed, even though I sent an email about it. But, you know, Coupa Software, this stock has gone straight up. It broke out of this downtrend. Volume, there's everything to like about this, but now it's incredibly extended, so you don't want to buy it here. But these are the kind of stocks that outperformed on this rally, that if the rally does get a pullback, these are the ones you want to try to find a good entry on, right? You want to look at to see, okay, this was leading coming out, it's going to pull back. At some point in time, where is a good place to get on board? And I don't know if it's the 80 level, but that looks like a decent area to try to, you know, pull back and really consolidate is on top of this 80 level. We shall see. What else do I want to look at on this? Okay. So this carbon black, this looks a lot like a DocuSign, but you know, you have these technology stocks. I mean, you could call that a breakout, but let's just look at the 50-day moving average. You want to focus on if a stock is changing its personality and it's been in a downtrend for a long time, then all of a sudden it gapped up and it's holding the 50-day moving average. So personality, in my opinion, has changed. I like to look for stocks that are changing personalities that I think are very, very early in the move. And I think this could be a potential candidate for that. Again, I don't necessarily like the market here. I think the market needs to ease, and I'm going to watch some of these stocks to see how they hold up. But, this is in the computer software security industry. Pretty good sales growth right here, pretty consistent. Mutual fund ownership has declined, hence, the mega sell-off, but sell-off could be overdone because now I'm paying attention to the volume, and volume is starting to step back in. So, this, what was resistance right here, could turn into support, and then it could base and then head higher. So just something to look at. Again, don't go out and buy these blindly, do your own research, but I'm trying to put some interesting setups in front of you, some stocks that are on my watch list that I'm keeping an eye on. I always try to look for stocks that I think are very, very early in the move and have the potential, for a 3-to-1 profit to loss reward.